Thanks for clicking. China's real estate market had a big week this week, with data coming in showing that recent efforts to re-stimulate the market have been largely unsuccessful, as prices continue to slow and sales continue to plunge. We also received a number of concerning reports this week, as more and more analysts are wondering if China is cooking its books, as the GDP numbers and the numbers for the rest of the economy are not adding up. These concerns were only amplified this week as Chinese authorities silenced a prominent market analyst who had been warning about potential capital outflows from China, that is, money leaving the Chinese Communist Party state.
Shut the f*** up!
So what I want to do today is skip over Evergrande again.
Awesome.
And go over China's real estate data as the situation is quantifiably worsening. Then I'm going to go over some of the major concerns being raised about the trustworthiness of the data coming out from China, as weak GDP, weak economic data is one thing, but weak economic data that you can't trust will send investors heading to the exits. Problems in China will inevitably spread to the West, and we're already starting to see reports that China's economic problems are contributing to the inflation rate here in Canada and the United States. We'll continue to have updates on China, on its real estate crisis, on its economy, and how that impacts the United States and Canada on this channel every Friday. If you want to get those updates, make sure you click like and subscribe, but for now, let's get into this real estate data. Data from April's real estate market is starting to come in, and despite attempts by Beijing and by the PBOC to re-stimulate the market, China's real estate is continuing to slow, both in terms of sales and in terms of price. The average price growth for real estate in China slowed from 0.03% in March to 0.02% in April. While that might not seem like a big drop, given the amount of support that we've seen from Beijing, from the PBOC, in terms of interest rate cuts, in terms of RRR cuts, curbs on restrictions on real estate developers, I'm sure Beijing was hoping to see the real estate growth go in the opposite direction.
You're going the wrong way!
Not only is pricing continuing to slow, but so are sales. The top 100 developers saw sales plunge 61.2% since this time last year. And sales also dropped in major cities. Of the 30 biggest cities in China, sales dropped 53.1%, which was an acceleration up from March's 47% drop. So price growth is down, the top developers are seeing their sales plummet, and the major cities are seeing a major slowdown since their sales data in March. All in all, a continual slowdown in China's real estate market.
This is a nightmare.
Last week we talked about China's local governments taking on more debt in order to replace the money they're not getting from real estate sales, and this is only going to compound the problem. The dismal real estate sales, the dismal real estate numbers coming out of China from April is only going to put more pressure on these local governments to take on more debt to fund the infrastructure projects being pushed on them by Beijing. And that's if the real estate data coming out is to be believed. Given China's widespread lockdowns, while Beijing continues to insist that its economy is growing, some are starting to question the validity of the data coming out from China. Continuing to question it. They've always questioned the data coming out of China, but this is at an elevated rate. Kirsten Holtz, an expert on Chinese statistics at Hong Kong University, says that with local governments under such pressure to deliver the goods, to deliver the infrastructure spending, there might be a big temptation there to fudge the data. Forbes says that given the large-scale lockdowns and the dismal Chinese real estate data, and we've talked before on this channel about China's real estate market representing 1/3 of its overall GDP, Forbes says that given these two factors, major lockdowns, low real estate data, the growth numbers coming out of China don't make any sense. This was echoed by Logan Wright, a Rhodium Group economist, who says that given that the materials going into China's real estate represent about 20% of its overall GDP, the rest of the sectors would have had to grow by 7 or 8% in order for the GDP numbers coming out from China to make sense. Given the widespread lockdowns, it's highly unlikely that the rest of the economy could have made up for the shortcomings coming from the real estate market, especially with the real estate market constituting such a high proportion of China's GDP. And it makes sense. If you'll remember during Canada's lockdowns, Bank of Canada Governor Tiff Macklem said that Canada was going to lean on the real estate market in order to get us through the pandemic.
Good idea, oh Lord.
Well, Canada's economy and that of China's are obviously vastly different. Canada could rely on its real estate market during our lockdowns to prevent a major drop in GDP. China doesn't have that option. China's having a real estate crisis at the same time that its COVID lockdowns or its COVID case numbers are almost the worst ever. So China doesn't have the option to lean on its real estate market in the same manner that we did here in the West, whether or not that was a good idea. But they don't have that option like we did, so their real estate numbers can't be propping up their GDP numbers, which China is still insisting are in that 4.8% range. And these concerns were only amplified further this week when China silenced a prominent market analyst in the Communist Party state. Market analyst Hong Hao, who has 3 million followers, had his account suspended after he appeared to be too bearish on the state of China's economy in the wake of the lockdowns, warning of potential capital flight. So not only are experts raising concerns about the validity of the data coming out from China, China is actively suppressing, actively silencing those that are critical of its handling of the economy, those that are critical of the state of the economy. And as we said at the beginning of the video, it's one thing when we get weak economic data from China. It's a whole nother problem when we see weak economic data coming from China that can't be trusted. And we've talked on this channel before that China does have a transparency problem. As this real estate crisis unfolded, as Evergrande went down, as Sinac, Kaisa went down, we started to see more and more developers come clean on their books, and even developers that were once considered strong ran into default because they were hiding their data, they were hiding their debts. And the real concern is this could be systemic wide. This could be throughout China. And with China fudging its GDP numbers, this is definitely not going to help investor sentiment, which will leave investors to pull their money out of China, increase borrowing costs in China, which will increase their prices, which will in turn increase the price of goods in Canada and in the United States. So with China already concerned over capital flight, stemming in large part from the real estate crisis, purposely falsifying its GDP data is definitely going to make things worse. We'll continue to have updates on the state of China's economy, on its real estate crisis, and how that affects us in Canada, in the United States, on this channel every Friday. If you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.